Well, hello and welcome to our live webinar on the new Know Your Business Imperative from periodic reviews to real-time monitoring. I'm Nathan Lynch, the Chief Correspondent for Regulation Asia, and I'm really delighted to be your moderator for this critical webinar for compliance and risk practitioners, regulators, and technology enthusiasts from across the Asia-Pacific region. Thanks so much to our audience for joining us today live, and our special thoughts go out to those in Hong Kong who are weathering Super Typhoon Regaza at the moment. Thank you for joining us, and if you're coming in on the recording, we completely understand that, and we're glad you're all safe. We will, of course, be making this available to watch on demand for anyone who couldn't make it or who experiences connectivity issues during this session. Please feel free to provide comments and questions throughout the webinar, and we will endeavour to address some of these either at the end or subsequently via email and via articles on Regulation Asia. So the topic for today, financial institutions across the Asia-Pacific region are facing dual pressures. There's a demand for faster, more seamless client onboarding, and there's also the threat, the escalating threat of complex and rapidly evolving financial crime. And scams is a big part of that, as we all know. So traditional periodic KYC reviews are proving insufficient against adversaries who change their tactics on a very frequent basis, creating compliance gaps and also finding vulnerabilities in our systems through ongoing penetration testing. In response to this threat landscape, regulators in key hubs such as Hong Kong and Singapore are raising their expectations, and this is driving a fundamental shift in the industry from static due diligence to dynamic continuous monitoring. In today's webinar, we'll be bringing together 3 industry experts to explore the real-world implications of this massive industry shift. The panellists will discuss the strategies and tools that firms are using to build a robust, continuous Know Your Business, KYB, framework that satisfies regulators and mitigates emerging risks in a sustainable way. On that note, it's my great delight to introduce our excellent speakers today. Thank you so much for your participation and sharing your insights with us. First up, we have Jean Chung, who is the Chief Compliance Officer for Hong Kong and Greater China and North Asia at Standard Chartered Bank in Hong Kong. Jean, it's some pretty radical weather up there. Thank you so much for being able to join us today.
Thank you so much for inviting me, and I really look forward to our conversation today, which is so critical topic for all of us. Thank you.
Really critical, and it's great to get a perspective from your bank, which is doing so much on this front. We also have Daniel Lim, who is the Head of Legal and Compliance at HL Bank in Singapore. Daniel, wonderful to have you with us, offering a perspective from a bank that deals with a lot of SMEs.
Yes, we do a lot of SMEs, and I'm very excited to join this webinar. This is great. I really need to get out there and listen to all the experts here, and that's really helpful.
Indeed. And thirdly, we have Klaus Christensen, who is the CEO and co-founder of Know Your Customer Limited, which is going to be able to, Klaus, you'll be able to give us a perspective on what role tech can play and the big innovations that we're seeing in this area. Thank you so much for dialing in from Europe.
Thanks for having me.
Pleasure's all ours. So let's kick straight into this discussion. I might begin, Jean, by asking you, from your perspective at Standard Chartered, how has the evolving threat landscape of money muling and transaction layering influenced your bank's approach to KYB processes, especially given the challenges associated with banking for SMEs in this area?
So Nathan, thank you for the question. Let me step a little back and really think about who the SME customers are. They are the root of our community, and there are legitimate SME business But because of the risks that we are identifying as an industry in smaller businesses, there is a real challenge for banks to almost sometimes de-risking SME customers. And this is where banks understanding who the real legitimate customers are is so important, which is the flip side of that coin is we need to identify those illegitimate SME clients. And yes, it is a challenge. I'm not going to say that this is easy peasy for all of us. But I think we need to start from that angle that we need to support the community, we need to support the SME business, and that is why it's more than ever important to really identify those bad actors. And this is where really knowing our customer, knowing our business customer, knowing our SME customers, whether they have a legitimate business, who own those business, what type of transactions they have, becomes so important. And also, when a customer is onboarded, really understanding their transaction patterns is also important because we need to ultimately decide whether they are legitimate.
Absolutely. And on that note, we're seeing a lot of messaging coming out from local regulators and indeed the Financial Action Task Force about the importance of a granular approach to de-risking, because de-risking, if it's done in a carte blanche fashion, creates its own financial crime risks. So Daniel, we've seen intense scrutiny from MAS in Singapore, including very regular fraud reporting obligations. So what specific regulatory expectations around knowing your business customers have been most challenging, do you think, for the SME banking sector in Singapore?
I think the requirements are very clear. The regulations are clear. You're supposed to find who the UBO is, right? And even if it was a complex structure, it is our job to be able to unwrap every layer until you reach the final owner of the business, right? The big issue is that, they don't necessarily have all the formal documentation. For example, the foreign shareholders, the BVI companies, or where they have complex ownership structures where you don't really see who the end users are. And also, we don't have the ability to scrutinize the legitimacy of these documents. So this is like seen in the case, recent one in MES from Singapore, where they picked up all these Fujian Pound people, and they were onboarding in Singapore to all the big banks. And they used documents because we have very stringent requirements to source of wealth that was completely forged. And I think some of the banks picked them up, but not all the banks pick all the documents up. And that's where a lot of the problems are. Nowadays, you see the AI come in and they can deep fake documents. They can deep fake the source of wealth, source of funds. They can deep fake the ownership. I've seen documents on sale of when they try to show where they get the money from. They show the sale and purchase agreement of a tea farm, for example. And that completely, we are unable to determine if this was fraud or otherwise. It's a very difficult thing to balance. We trying to comply with the regulatory requirements and to provide a frictionless onboarding experience for the clients, which we aspire to, because like what Jean said, that these are legitimate customers, they are legitimately trying to start a banking relationship with you. They may not be bad actors, but in order to comply with the regulations, and we're getting tighter and tighter every year, we start making it difficult for customers, and that can't be the answer.
It can be very frustrating for legitimate customers, and likewise, we hear reports from banks that large numbers of applications, when they do get kicked back, simply disappear into the ether, which gives us an indication that there may be large numbers of clients that are just doing penetration testing and looking for vulnerabilities. Daniel, is that something that you've seen?
Yes, and this we always feel a certain sense of like respect, almost, because they are so systematic when they deal with this penetration testing. We used to do this fraud testing. We look at all the where these money mules come about, what kind of accounts they open, and we used to do it every quarter. Now that's obsolete. We have to do it every month because month on month their patterns change. We used to block them based on their occupations, where they have some that are very clustered upon some of the major occupations. Now there is no such clustering. They actually seem to have a systematic way in which to organize who each person is. So when you used to have 10 people who are students, now you have one person is a service actor, one is somebody who works in a bank, one works in construction, and it's very difficult. And they are so systematic about it. It's really very, very hard to actually now tie down who these bad actors are. And they're very, 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 very fast at it as well.
You've highlighted an incredibly important point there, Daniel, which is that we should always respect our adversary because of their determination. And as it's often said, they have all the money and none of the rules, and we have all the rules and not enough money. But it's amazing to see what people in the industry are doing, and if only these bad actors would direct their attention to improving society rather than undermining it. So on that note, Klaus, how is the RegTech sector evolving in response to these challenges? I understand that now you're able to source KYB information live from authoritative government registries. Is that right?
There's a lot happening in the industry, and there's big shifts currently underway. I definitely see that. And of course, we've been 10 years now in this industry and have been part of it and saw a lot in that time. But first of all, let me comment on that. Looking at your adversaries, I think when I entered anti-money laundering as a profession, as a topic, because I'm the technical co-founder at KYC, and so I came from the tech side. Tech is always an applied science. So we apply it to something. So I needed to learn this new topic, and I found it very interesting. But that wasn't the same for a lot of my friends and colleagues. They didn't think AML, KYB, KYC would be fascinating, but it is, especially if you look at your adversaries. I think here in this community, in this webinar, we're working on that. We're working against some very big forces. It's very, very interesting. And as we picking up from Gene, it is actually a big challenge in our industry, specifically about SMEs. SMEs are the backbone. Hong Kong has 1.4 million registered limited companies. Just let that sit. So 7.5 million people, and they have 1.4 million companies. Obviously, the vast majority of them are SMEs, are small businesses, and they are so important. And that's also a big difference between Europe and Asia. And all our Asian operations, SMEs are like preeminent. It's the topic for everybody. And it's difficult because at the same time, SMEs are challenging to make money off in just an account, and they are higher risk. And that's where automation and tech and so comes in, and that's where we come in again. Yeah. So what I've seen, to answer your question, really to come back to this, what I've seen in the industry is there's been huge shifts in how KYB or business entity verification is done over time. In the very beginning, it was just manual. Then the industry came in and automated that manual process with upload your document here and then click here and then submit your information and type in your information and so on a website. That's like the first step. There was one big industry called workflows, and that's still going, that's still there. And another development was that the industry started to building databases of entities, which started collecting information about corporate entities, their directors, their shareholders, and thereby the UBOs in the end, from all sorts of sources, from self-reported credit information, from credit scoring agencies, and from all sorts of public sources. And these were the backbone of like the first wave of automation, where financial institutions were referring to those databases and check, is this really a director of this company? Is this really an owner? Because the database says so. Now we're going into a much more dynamic age. As we heard from Daniel, Hong Leong sees that people are now using AI to spin up fake documents in no time. And so the idea of relying on documents is kind of gone if they come from the customer. And so there's one step left that really secures things, and that is going straight to the government source of information, and that's the company registries. It's very difficult to connect to them, but they do have the documents, and you can source them there. And that's exactly what we do. This is indeed not just us, but this is a new wave in the industry that you switch from any of the workflow, any of the database driven, to this new way of connecting live to company registries and read and process these documents. They're always fresh. They're always audit ready, because you can always point your regulator to their own source. This is why we decided so. And it also generates a big operational lift. So this automation means it is now possible to onboard KYB process and AML process SMEs at scale at low cost. And that's altogether what the industry moved to.
Mm-hmm. And you've hit the nail on the head there, Klaus, with regard to the passion that this community has for innovation and doing great work. And we're very grateful that you went from tech into our field, and I'm sure you've found that the professional community and the passion that people have for this important work is one of the really unique things about the financial crime compliance sector.
That's right. Yeah, I'm very happy with coming into this community, and I met amazing people here, including Daniel and Jean here, and the fintech associations in both Hong Kong and Singapore where we engage, and it is a real community.
Absolutely, and the regulators are pretty amazing as well. There's such great people working with those, which is really refreshing, because often in other areas of financial services there's more of an adversarial relationship with regulators, but in the AML and anti-scam space, where we all have a common interest. So Daniel, that brings me to perhaps ask you, in cases where MAS has flagged post-onboarding issues with seemingly legitimate business customers, like the cases you spoke about earlier, what difficulties do you think banks would encounter when they go to retrospectively identify risks and customers, and looking at some of the fraudulent documents that might have been used?
It's really difficult to detect. I mean, I've got cases where the earlier did flag that something is wrong with this customer and with the transaction. So we actually called back the documents for this customer, and we went through every single transaction with a fine-tooth comb. We were looking at it really, really carefully, and we can't really detect what was wrong with it. And this is the problem, because all the assessments were done at that point in time. It's legit. You know that it is legit. There's no adverse news. You don't have anything on the customer. But this is a snapshot, right? And the customer's behavior can change. And especially if you don't have any adverse news, they're not from a very high risk country, for example. This is a low or medium risk customer. We don't review them pretty often. I mean, some are only reviewed 7 years, some are reviewed 3 years. So in the meantime, this sort of situation, the customer can start acting badly and we wouldn't know. All right. We can only see their transactions. Everything we see is siloed. We only see what they do on our system, on our accounts. So we don't know what they do outside of our own ecosystem. So we start to miss all these critical red flags, right? So like what you've come across just now, we are a small bank, we don't have access to Cosmic. It certainly makes it very, very challenging for us to be able to actually catch of these red flags, right? And this is a problem, and I think that a lot of criminals will start to see this, and this is something that they will certainly be able to exploit for the benefit. I think, yeah, this is a problem for us.
Yeah, this issue of displacement and the displacement effect is really challenging, particularly with public-private partnerships, which in their very nature can't really scale for the whole industry at this stage, at least. Klaus, would you like to throw any responses in there to the points that Daniel's raised?
Well, if you think about this whole new wave of fake documents and so on, obviously the right way is not to rely on them. The interesting point about corporate structures SMEs or any corporates is that they are dynamic structures. And that's the one thing we should always remember when dealing with them. If you identify a person, they don't change their identity. I'm always Klaus. You can get a PhD and change the name a little bit, can marry, but it's always the same person. Now, a corporate identity is very, very different beast. It's dynamic by nature. It can change its constituent parts, its controlling entities, directors, corporate secretary, and so on, any business day. And it can change their corporate structure, the beneficial owners, any business day, can issue new shares, can sell, and so on. And so this dynamic nature is what makes it so interesting and also so challenging. And that's what we're all working on.
Absolutely. So, Jean, from your perspective, I mean, this deep fake issue and the use of AI to develop incredibly convincing fraudulent documents is such a challenge. And Daniel's highlighted the issue of bad actors using these forged documents and shell companies and the like during onboarding, as we've seen in these past cases like the Fujian scandal. What steps are banks taking to independently verify customer data and mitigate the risks of these forged documents, as challenging as that is?
It is challenge. It is a challenge. Where we have an acceptable data source or legitimate data source, like what Klaus mentioned about government registry, etc. Of course, as part of our onboarding, KYC or client due diligence, we receive all the documents from our customers, but where applicable and where available, we need to always check against that golden source, whether that's a government database and whatnot. Of course, we have that process in place. We did have this conversation at the industry forum and as well as with the regulators. We also need to probably develop our own technology using AI to detect those deepfake documents. It's like forever competition between the bad actors and us. We need to also have that technology to detect if there was any submitted documents are deepfake, and that will be an indicator for us to then perform additional diligence if that, because this can be a factor. Again, I don't think, I mean, artificial intelligence and all this technology innovation is not silver bullet, but we also need to have our own mechanism to make sure that we can detect those and utilize all possible angles to validate those information that our customers submit as part of the onboarding. At the same time, if let's say, as Daniel said, somehow we were not able to detect that as part of the onboarding process, another angle is banks have to have a very robust transaction monitoring, because probably there'll be anomaly. We can identify in their transaction patterns, and knowing your customer or knowing your customer combined with really understanding their transaction pattern is how we really know our customer. So the agility to agile approach to really understand the risk profile of customer is very important, which is fundamental to our risk management program for all the banking industry.
Absolutely. And that combination of human intelligence and technology is really powerful. But at the end of the day, agility and developing agility, not only in our tech systems, but also in our process and practices for human staff is really important. I might jump into some of the questions, the great questions that are coming in now from the audience. Klaus, this is probably a nice one for you. We've got a question from Tommy in Singapore, who's asked that how often should we be doing checks and rechecks on our SME customers' data? How do we find the sweet spot for ongoing EDD? I would imagine you have a good response for that.
It's actually not that easy to answer, because the regulator is not that prescriptive. I actually put that question over to Daniel and Jean, what MAS and HKMA typically expect. But the normal frequency is this 1, 3, 5 year period at the moment, like 1 year for high risk, every year for high risk. 3 years for medium and 5 for low. It used to be slower, but that's more or less the expectation. It's not written in the regulation. So you'd have to talk to your regulator, I'd say. Or Jean, do you know any more?
It's a risk appetite conversation for
Yeah.
your organization. But having said that, going to Tommy's question here, how I would kind of think is if, let's say, we use Klaus, your solution, and because you will then feed information whenever there's any changes to the directorship or related parties to an entity, and that happens so frequently for one entity, then I will probably start a trigger review. And then also look at the transactions to see whether is there any other red flag that we need to be aware of. So I would probably consider that as a input to my overall risk management approach.
Yeah.
Absolutely. And Tommy, there's a sort of a new dynamic now, which is rather than doing the regulatory minimum requirement, which was embedded into fairly static systems, now there's this event-driven approach to EDD. So you know, using technology to give you a prompt when there's been a change is a really, really wonderful development that we're going to discuss in more detail as we go on today. So Daniel, you know, sorry, Klaus, with your system, your coverage now on that subject is spanning 146 jurisdictions, which is pretty staggering. How does that global connectivity help financial institutions such as Tommy's address the international challenges with KYB, such as cross-border ownership structures?
Yeah, there's still some countries left. I mean, 146 countries is not bad. It's good coverage, but there's about 196. So we still have 50 left. Working on that, but the main ones and all the Asian ones around our main bases, Hong Kong and Singapore, our European ones are all covered. Now, why is that important? I think what we see internationally and what we see in multiple regions is that the structures that we work with, we work with for our customers in both Europe and Asia, are getting more complex. It's just a simple fact. Even SMEs often have a double structure now. There's a holding company for ease of sale later on, and there's an operational company. And many international connections, especially in Asia, where things are so hyper connected with each other, the whole Southeast Asian entities connected to Singapore, Singapore connected to Hong Kong, Hong Kong being so connected to North Asia, Greater Bay Area. All these connections mean many structures go cross-border. So it's no longer enough to have a solution that can identify, or a manual approach that can identify local customers in your local area just at one level, because they are not one level. You have to go cross-border. So I think it's a general accumulation of more complexity in corporate structures because it's no longer that hard. I remember like even 10 years ago, it was a longer process incorporating a company. I was surprised how fast Hong Kong incorporation was. It was always same day. I wasn't used to that in Europe. It typically took weeks. And this development that it shrunk the timeline to incorporate new entities and make it easier and make it cheaper, that caused more complex entities. And so that's why today it's more important. The other thing is just simple trade. Trade means there's many more connections internationally, and that result in it, many more connections in corporate entities that made KYB more complex. That's what you need to solve with some technology.
Yeah, the double-edged sword of being a major global trading hub like Singapore and Hong Kong is that this is incredibly challenging, and for the reasons you've just said. There's a great comment here from Angela, and I might throw this to Daniel. She's asked, is there any value in regulators, banks, or third-party service providers designing penetration tests similar to secret shoppers to help financial institutions and non-FIs test the robustness of their KYC and transaction monitoring. Are you familiar with anything like that?
No, haven't heard of anything like that.
I
I'm
love
just,
the idea.
but
We
I'm
should
not
try
sure that
that.
anybody is that fast, you know. I think if the money is your objective, you know, the people who make the most money are just going to be the ones that are bad actors. They're just going to be faster than anything out there. I mean, you can design your system. I still need to go through corporate governance. They don't have corporate governance. They can do everything tomorrow and they will test it on you. It's very hard to keep abreast of their speed. I think this is the thing. I'm not sure that this will be helpful that much. It just gives us more work, but I guess that's an idea.
It's certainly more work. I mean, we're all familiar, of course, with the phishing emails that cybersecurity companies send out, and if you click on it, you get chastised by your IT team. So maybe there is some there's Angela, maybe there's a business idea here. Maybe it's off the ground. I think it'd be great. So look, faster onboarding, Gene, is really critical and it's a major goal for many banks. As we heard Klaus say earlier, reducing that friction and making sure that you can have same day company ownership is one of the great things about Hong Kong, for instance. But it often conflicts with robust KYB requirements. So how do you believe banks can balance the need for efficient business customer onboarding, eliminating that frustration and helping legitimate businesses to grow? Because of course, every large business was once a small or medium-sized business. How can you do that while minimizing the risk of onboarding potential money mules or getting involved with the TBML and laundering entities?
That's a really good question. Again, let's step back to about 5 to 10 years ago, where even for individual, not talking about SME customers, but individuals, it took we didn't have like straight through processing. We had to all walk into a branch, and we had all this thick application forms to fill in. Right now, it's just you can open an account online, etc. Because there are ways for us to validate, Nathan, your identity, right? With all the connection to government database, connection to that and this and that. So there are ways for us to validate that identity. With the SME business, there's a segment of customers, I think we need to have more that type of golden source of information so that we can rely on the source to then validate what the customer submitted. I think we need to have that. I don't think as an industry we have solved that problem statement of onboarding an SME client straight through processing, because we do recognize this is a high risk portfolio. But I think there's the technology bit that we can, fintech companies like Klaus's KYC and other information source we can rely on. At the same time, we
Full
just need to
disclosure
have,
here, we
yeah,
do work together. Gene and I,
yeah,
we
yes, yes,
KYC is a vendor
KYC, yeah, Klaus
for
companies are a
Standard
vendor.
Chartered.
Yeah,
Yeah.
yeah, full disclosure. But at the same time, I think we need to look at this more holistically, because depending on how your risk appetite is determined, we can onboard as long as we're satisfied with all the documents our applicants or SME customers submit, and we decide to open an account. You can, based on certain indicators, you can apply additional controls so that you really look at the transactions post onboarding, right? And that way we can also create our own typology that, okay, this type of customers, I think we can continue with this, I would say, less controls. Whereas certain type of customer profile, certain type of industry, certain type that you determine based on your own analysis, we just put a lot of controls so that we can identify those bad actors early on. At the same time, what's really important is money mules, and etc. And as everyone knows, it used to be the case that individual accounts were used as money mules, but now we see more and more SME accounts, because those victims who were scammed because of investment, some proposition or whatnot, they have more comfort when they send money to a company account instead of an individual account. So a lot of SME accounts are actually used as mule accounts. As a big organization compared to Daniel's, we do have information. We have identified based on our own control framework those money mules, and we can blacklist them. And we also share information amongst banks through in Singapore. You have Cosmic. In Hong Kong, we have our own information sharing mechanism. Through that, we know known mules that other banks have identified, and we use that to also scan our own client database to identify those bad actors, vice versa. And so we can have all the robust processes and controls to the extent possible we can have, but information sharing becomes really, really critical here because it's easy for them to open an account in multiple banks and spread their transaction across all these multiple banks. Therefore, from one bank perspective, we may not have all the information, but when when the community comes together and share the information, then we can really connect the dots to identify those bad actors. I think all these control measures can then create an environment where we can actually onboard faster onboarding. We can allow faster onboarding for legitimate SME customers.
Jean, that is such a fascinating, well, all of that's a fascinating insight, and particularly around the use of these corporate accounts. I think it's quite counterintuitive that you would use accounts that are harder and more time consuming to open than personal accounts. It's another example of how, as we lift the bar in terms of community awareness around these issues of scams and the like, that the scammers become more sophisticated and change their methodology. So that's really interesting, and it highlights the importance of this. So Klaus, in the context of the rising threat of scams, and the reality that money laundering or anti-money laundering has typically been about intelligence gathering after the fact, but now it's increasingly, as we look at scams, becoming about prevention, and there's a lot more pressure to be real time in the way we go about it. Can you give us an insight into how this can work using technology? So how real-time know your business solutions like yours can help banks to mitigate these risks of, for instance, onboarding a customer that's legitimate, but then there's a change in ownership and that company goes bad. How can you help with that?
Yeah. Traditional ways of doing this KYB process always had this challenge that they took a snapshot and they worked on the snapshot in a database for many months or even years. This is the company, this is who they are, this is their directors and so on. And that wasn't necessarily true anymore after just a few days or weeks. Because especially in cases of fraud, that is what you would want to do. You onboard with a bank, you start with a specific company with all clean people involved, and then you hand it over to someone who's nefarious and probably well known. And they are now the new owners or the new directors and control the company, and the account is open. To prevent that, what you need is, first of all, you need live access. You can't rely on old information, even at the point of onboarding. But continuing after onboarding, the next step is now to go that step further and have a live feed. That means trigger points that are automatically initiated when anything changes. And we've had that even in the database world. Big entity databases sometimes offer that as perpetual KYC. We tell you when something changes, but that always meant we tell you when we learn that something changes, not when it actually happened months or a year ago. This new technology now that we implemented in certain jurisdictions is we see the same day a director filing has happened, or a share issue filing has happened, or any other critical things like charges to the company has happened, and we immediately trigger that to the bank and tell them something has changed here. Do you want us to draw the new documents and tell you exactly what happened? And that's the new wave that's coming now that will prevent more and more of these very easy circumventions of the old way of doing things.
And how do you go about that? I mean, I guess there's two issues here. One is the cost of pinging the database. So are you able to get notifications and then probe those in response to a customer request? And also, how can you ensure the absolute accuracy of this data when you're automating the process? Because you know, with so many tech solutions being 99 or 98% accurate isn't enough. The customer has to be completely able to rely on that solution to, in fact, rely on it.
Yeah. Well, quality was always our integrity, and quality was always our highest good and is our highest good at Know Your Customer. This solution is nothing without the belief of our customers that its quality stands. If there is any question about it, then why use it? Then they can just go back to manual way and ask the customer for documents and do their best. So this was always from the very beginning in the design phase and in the whole history of the company, our preeminent idea. But it expresses itself in our way of handling things. So we have dozens, really dozens of consistency checks built into the system when the data is retrieved. The simplest may be, for example, we add up the number of shares that each shareholder has, and then compare it to the total number of shares, which is on a different form or a different page in the annual return of a company, that sort of thing. So if that doesn't match, what can we do then? And that is where we add a total new layer in our company. We have a manual team. That sounds counterintuitive. Why would an automation company have a manual team? It's a very small team. But that's our ultimate defense. When anything pops up there, the software says, I could not read the exact name, there's an OCR error, or the software says the number of shares doesn't match, we send it over to a manual team to review. And that team has this is belts and suspenders and triple suspenders, really. That team is double packed. So we have two teams that do this at the same time. And then there's a supervisor who decides which solution is right if they're different. So we really go all the way up to the top. But that isn't actually why the quality is so good. The quality is the 99 to 100% really is from that. But the 99% is through the automation. Like without automation, the quality is always lower. You always have many more manual errors. And just people who on a Monday morning or after typhoon come into the bank and just click, okay, it's all good. And don't do the checks. The automation makes sure it happens.
Absolutely. I mean, 10 years ago, this would have been a pipe dream. So the sophistication of the automation now is incredible, and it's great that such solutions are available. Daniel, there's a question here from Anonymous. I always love anonymous questions because they're usually juicy. And they have asked that, coming from the perspective of an AML practitioner, is the CDD risk-based approach effective in practice? And they're asking, how easy is it for the compliance function to go overboard and raise operational cost relative to revenue? This is a perennial issue. Any thoughts there?
Yeah, but we have limited resources, and it's really, really hard to be able to actually rank them. So this is how we think is the best way to be able to handle the more higher risk customers. If I have unlimited resources or AI comes into play and then I can deal with every single case immediately, then maybe you're right. Then the CDD risk-based approach not really valid. But now, as it is, I need to look after the high risk, very high risk, tends to be a little bit more disingenuous of countries or professions where I really need to scrutinize it a little bit harder. And I do agree, some of the low and medium risk could also potentially be high risk. But I need to prioritize some way, and this is probably at this point in time the best way to do it.
If I may add there, again, this is where the transaction monitoring becomes really, really critical, because it may be the case that as part of onboarding or our periodic review, the client profile itself may be a low risk, but when the through transaction monitoring, we have a red flag or a trigger event, that's when we have an opportunity to really understand whether the client is really lower risk. So that's why it's now like we are saying perpetual KYC, because KYC in this is kind of broader terms, because we really need to know our customer, and knowing our customer is not necessarily through doing the KYC process. It's more to look at the entire life cycle of our customer. So I would just like highlight that point. So on the point of what Klaus just mentioned about all those information that that we can know on a real-time basis, isn't it? It wouldn't be amazing if, let's say, whenever there's we know through information sharing or our own process, confirm money mules or confirm bad actor, right? And we know who their beneficial owners are, or who the directors of those company are, and we can do the network analysis of who else and what companies, what other companies these individuals own. And then we go down the path. It's more of a network analysis, right? That'll be kind of amazing. And with all the information sharing, if we can also share that among us for bad actors, then we can have a lot of preemptive controls, so that we can then focus on legitimate customers.
Absolutely.
Wild
This is
idea.
Jean, this is one of the great things that's happening in Australia with the Fintel Alliance by co-locating some of the largest reporters in the same room. They can effectively do that in real time around specific projects that are aligned with law
Yeah,
enforcement.
public-private partnership like GIMLET in UK and FIMLET in
Yeah,
Hong Kong, right? And ASIC in Singapore. Yes, indeed.
it's really exciting and very rewarding when you see the outcomes of that. I
Mm-hmm.
know it's great for compliance teams as well in those public-private partnerships to get the immediate feedback on the value of their work. Often there's a delay or confidentiality issues where they can't find out about the value of their financial intelligence, but it's really fantastic if you can become part of those.
Yeah.
So Daniel, penetration testing by criminals, it's constantly evolving, and they're changing their transaction patterns on a month-to-month basis, trying to find weaknesses and vulnerabilities. What does this mean at a practical level for the AML community?
I think this is a call for us to actually gather, our resources, like what you have suggested. I was just sharing with a couple of the youth recently that, this is a zero-sum game, right? Everybody is looking for the simplest bank to onboard. So if you are the simplest bank in Singapore to onboard, all the money needs to come to you. And then we had a case where one of the banks changed their processes, and suddenly everybody seems to be flooding to us. And then I sat down and I went. Fortunately, I knew the head of legal of the other bank. I got them in and I had a chat with him and we discovered what they were doing. And by sharing that information, I implemented it in HR Bank, and suddenly the number of money mule cases fell precipitously. That is the power of actually coming together, sharing information, sharing the network, having sort of like these sort of gatherings and trying to understand how we can really do it. It's about being agile. We cannot be reactive. We need to be proactive. We need to go out there and get things done. This I think is the lesson I've learned.
Absolutely. It's good to cultivate a mindset of perpetual unease. And if you find yourself suddenly being the most popular bank in your jurisdiction, that's maybe not something to celebrate anymore.
Well, actually, the thing is, yes, the weakest link can really impact the entire industry, but then we also have other industry players too, not just banks, right? So
Yeah.
as a, I would say, financial industry, not just banking sector, but all other sectors, we do need to find a way to collaborate.
Jean, we have a question here that I think could be an interesting one for you to answer. And they're asking, do small time, we're hearing all this about sophistication, and they're asking, do small time money launderers still exist, or are they usually quite large scale?
Thank you, Nathan, because I was going to type answer to that question.
Save your fingers.
Yes. So first of all, thank you for that question. Of course, when we do some analysis of the profile or typology, typically they're smaller setup. But then when we identify similar patterns of transactions, we do identify other entities, and later we learn through police that it's a syndicate. So a criminal syndicate. So criminal syndicate can set up multiple small entities and have accounts open with multiple banks, and they use this network of smaller entities to launder money. So I don't think it's a yes or no question to that. I mean, yes or no answer to your question. Um, Typically, we see syndicate, but then syndicate, it's all relative, right? Whether the syndicate is a big crime syndicate or small size syndicate. But we see a lot of those type of network players.
Absolutely. And this concept of crime as a service, where the adversaries are getting on the dark web and coordinating and bringing people in to bring expertise that they might not have, is another reality of
Yeah,
the.
and just now Sylvia just answered, wow, so they use small entities as a front, but in their aggregate is quite large. We do see that, and this is where collaborating with police, because through police, they will also coordinate with all other banks to identify those criminal syndicates. I'm not saying it's always the case, but we've seen often enough to identify those syndicates.
Yeah. It's quite incredible. We've seen with some of the failures with intelligent deposit machines, for instance, where the organised crime community got wind of that and the problem exploded at a pace that was quite incredible. So there's clearly some information sharing going on, and perhaps smaller freelance cells are part of a bigger organisation. Really great points there. So Jean, let's look ahead now. We've got a few minutes left, and I'm wondering, with the adversaries continually adapting their modus operandi and changing transaction patterns, what do you see as the key takeaways for industry collaboration and intel sharing and fighting this scourge?
Okay, let me go back to the basics. We need to really know our customer, and we need to innovate our transaction monitoring system, because typically bigger banks, and also probably all other players in this industry, transaction monitoring systems are really post-transaction, and also it takes quite a long time to really identify the transaction patterns. I think we need to utilize the innovation in technology to identify those patterns as early as possible, so that we understand our customer holistically. And then, and we need to do that, our homework first. At the same time, we need to just collaborate with our industry players and work with law enforcement agencies, because at the end of the day, we are all here, we're all doing our work so that we identify those criminal networks, we identify those bad actors, so that we can focus on our legitimate customers. So that collaboration with law enforcement agencies, that's public and private, all our colleagues in other private sector, we need to really work together to share the intelligence, where we already have that through Cosmic in Singapore, through our finance in Hong Kong, and also public-private partnership. That intelligence sharing is really, really important to really up our game when the criminal enterprise, they do not have framework, they do not have jurisdiction, they do not have all these rules to follow. So the only way we can fight them is through collaboration.
That's really, really profound and wonderful. And Jean, you very much epitomise the idea that while we compete with honour in the financial sector to be better and to win customers, there's these big picture areas where it's really a joint effort and a collaboration. So thank you for those closing thoughts. Klaus, we've discussed this idea of perpetual KYC and event-driven monitoring. How do you see this going forward? Will it become the new de facto standard that we move to being more real time in this area?
I'd say yes. We already discussed how it's advantageous to do that. You miss less of these actors moving around entities and moving around directors after the fact, after onboarding, and you're much more current. Will we move toward that as a new standard? I'm sure we will, because of both the pressures from the industry themselves, institutions like Standard Chartered and DBS in Singapore, and I'm sure also Hong Leong, Daniels Bank, have their own standards. And these standards are high, and they want to prevent fraud and they want to prevent money laundering. And so they will use what is available more and more. But at the same time, I think the regulator plays a big role. And we've seen that in the past. The regulations, initially the anti-money laundering regulations out of FATF and then transposed into national regulations and laws, were written in their first versions more or less for a paper-based process. And that has changed. The regulations today more and more incorporate the idea, yes, there will be use of technology, and therefore these additional data points aren't too onerous to also collect, and therefore we can increase regulation to this new level where we just suppose it's there, the technology, and write the regulation from that viewpoint. And I think the same will happen from on the standpoint of perpetual KYC. In a few years, the new level of regulations will just make sure that nobody relies on outdated information anymore and is always updated automatically, because it's possible, because the regulator knows that. And that's one big advantage of Asia, actually. Since we have this viewpoint between Europe and Asia, the European regulators and banks are a little bit, and central banks are a little bit behind and not as engaging with the industry as both MAS and HKMA, especially the MA, are, with special RegTech events, special RegTech connections at Singapore FinTech Festival between the regulator and the industry, both happening on both cities. I think that's amazing. It's a level that we haven't seen anywhere else.
That's
So
fantastic.
I'm positive and I'm optimistic for the future that way. But just to continue the thought of Jean, just as my last thought, is agility really. We will not know what the future holds there from the money launderers. They will use a lot more AI, so are we. And whatever they throw at us, we'll deal with it as an industry and as a community.
That's a great parting thought. And Daniel, if I could throw to you now, we've heard about the crucial aspect of supporting small and medium enterprises for the economic and social benefit. Likewise, it's really important that we have small and medium-sized financial institutions and a rich financial ecosystem. Getting back to that displacement issue, how important do you think it is that banks like yours are able to be part of things like COSMIC and public-private partnerships to ensure that the problem of money laundering doesn't get displaced down the food chain, as it were?
Yeah, I think it's absolutely critical. It's I share, I think, the thoughts of Jean and Claude as well. Without this data sharing collaboration, we work very closely with the police as well. These sort of interactions give us at least a chance of stopping them, because they move so fast, they're so agile. Larger banks have this immense number of customers and transactional data. So Jean can look at their past data. When we look at our past data, we don't get anything other than the transactions within that account. It could be as little as 9 cents transactions, and I don't see anything outside of our own bank's view. And it's very hard, therefore, to be able to come to a view on whether or not this person is nefarious if we only have that 9 transactions. So I think, yeah, we need to expand conflict access. Then we are able to compete effectively. At least we can try to stop all these bad actors in money mules and such more effectively, right? And it also allows us to identify these people who will go from bank to bank. You know who these bad actors are, and then we can stop them flat immediately without having to be hit with something. Then discover that, oh, actually this was part of a group, and that's happened. We've got a lot of these POs that come in from the regulators that come in and tell you, look, this client is part of a larger syndicate, and I'm caught off guard. I don't know. It's not possible for us to know that this is happening, and I think this really affects our ability to do this properly. I think.
Absolutely. Well, you can see from today's session, there's no shortage of goodwill and willingness to collaborate and learn and share, and that's just a wonderful thing. So we are out of time, but thank you so much for joining us on this live webinar today, and thank you for your questions. They were really insightful, and we'll get to the ones that we didn't have time for subsequently, either on Regulation Asia or via email. And thank you for anyone who's listening in on the recorded version. We really hope you enjoyed today's presentation as much as I did with our amazing subject matter experts, Jean, Daniel, and Klaus. Thank you. Thank you to the three of you for your generous time and knowledge sharing today.
Thank you.
Thank you, everyone.
Anytime, Nathan. Thank you.
Oh, really, it was a pleasure. And thank you again for joining us on behalf of the team at Regulation Asia. Please email us if you have any further feedback or questions. It's always appreciated. And visit regulationasia.com for more analysis of the big issues facing risk and compliance teams in the Asia Pacific region. I'm Nathan Lynch, and until next time, stay connected, stay dry if you're up there in Hong Kong, please. And of course, for those in industry, stay compliant. Thank you.